This is your Wall Street wake-up call. Global stocks are steady after Monday's rebound. Let's get straight to Michael Ingram now. He's a market analyst with BGC Partners in London. So, Michael, help us understand this. I mean, we had a 400-point drop in the Dow on Friday over somewhat hawkish Fed commentary, and then a 250-point rise in the Dow yesterday on Monday amidst more dovish Fed chatter.
Yeah, exactly. So, you wonder what the panic was about in the first place. I mean, these are pretty big moves on the basis of what is actually on paper quite a modest reappraisal of the Fed's intentions next week. We went from a 30% implied probability of a rate hike in September down to 22% this morning, and as you say, all that volatility out on Wall Street. Interesting to see that we didn't see that strong close in the US reflected in Asian equities overnight, and it's really continued forward into the European session. Volumes are certainly nothing to write home about. Markets overall treading water. We're seeing pharma pretty well bid. We're seeing materials up, but we're also seeing some lagging sectors. Financials are down again, I guess, on this lower for longer interest rate theme, which is being revived yet again. And noticeably also energy companies, who I think are probably suffering from that IEA downgrade earlier on this morning.
Well, how would you trade this market? I mean, how would you characterize it? Is it, good news is good news is bad news is bad news? I mean, what's the bucket you would put this market in?
Yeah, if you try and rationalize it too much, it will make your ears bleed, Scott. I mean, I think what we're really looking is a generally low conviction market. It's very, very jittery. Liquidity is extremely sporadic. I mean, yesterday was a very heavy volume day. One might have otherwise expected, given that Lael Brainard effectively delivered what the market wanted, which was a very dovish speech. You might have expected a better recovery on big volume. You just haven't seen it, and I think part of the worry is that if you look at the macro, the numbers that we've seen out of Europe thus far in September have been pretty disappointing. The ZEW out of Germany this morning for September, was a touch soft for sure. The earnings numbers, they've come down quite a long way in Europe. They're not really going up. So there's an absence of bad news, but there's no good news out there. And of course, we're starting to realize that low interest rates over a prolonged period are very double-edged swords, particularly for the banking sector. We've seen a lot of banks, particularly in Germany, being very vocal about this, and they're just saying, well, hang on, maybe bad news isn't good news either. So what we actually need is good news, Scott. And there's an absence of good news, and we can't make bad news good news. So what do markets do by default? Well, they're treading water. That's exactly what they're doing today.
And Michael, in the last 20 seconds we have, let's talk about the IEA cutting its oil outlook for the rest of the year amid weak growth or demand in Asia.
Yeah, I mean, they've actually used the word, I think, collapse for demand in China and India. And of course, emerging markets had to be a key source of incremental demand for oil for many, many years now. And also on the flip side of that, they're expecting the market to remain very well supplied well into 2017. That's why you're seeing crude down, and that's why you're seeing energy stocks suffering.
All right, Michael Ingram, a market analyst with BGC Partners in London. Michael, thank you.
Pleasure as always, Scott.
I'm Scott Gamm, and you're watching The Street.